$300 borrowed, $1,200 paid in fees, and the $300 is still owed. That is not a typo, and it is not a horror story pulled from the far edge of the market. It is an ordinary arithmetic outcome for a product sold legally at storefronts with bright signage in most American strip malls. A borrower walks in needing $300 to cover a car repair before payday. 8 months later, that borrower has handed over 4 times the amount she borrowed, and the original balance has not moved a cent. Read the number one way and it looks like tragedy, a person overwhelmed by circumstance. Read it the way the industry reads it, and it looks like something else entirely, a fully performing account. Here is what that figure hides. The 400% effective annual rate that makes headlines is almost a distraction because a rate assumes the loan gets repaid on a schedule. This loan was never on a schedule. Every 2 weeks, the borrower paid a fee, call it $45 on that $300, to be allowed to keep the loan open for another 2 weeks. She was not paying down the debt. She was renting the right to still owe it. $45. Then $45 again. Then again, roughly 26 times across those 8 months. $1,200. And because none of it touched principal, the $300 remained exactly where it started, waiting for the next fee. Now recalculate the transaction from the lender's side, because that is where the design becomes visible. The lender did not want the $300 back. The $300 coming back would have ended the relationship. What the lender wanted was the $45, repeated, indefinitely. The unpaid principal was not a loss on the books. It was the anchor, the thing that guaranteed the borrower returned every 14 days to pay rent on it. In that framing, the customer who never escapes is not a failure of the model. She is the model performing as intended. This inverts something most people assume about lending. A conventional loan makes money when the borrower succeeds, pays it back with interest, and both sides move on. A significant slice of American consumer finance was rebuilt to make its money the opposite way. It earns most when the borrower cannot get out. Repayment is the failure state. Renewal is the product. Which raises the question this entire investigation exists to answer, and it is not the obvious one. The obvious question is how anyone could allow this. The harder question, the one that actually explains the machine, is this. If an industry needs its customers to fail, needs them to keep owing, needs the $300 to stay unpaid forever, why do those same customers keep coming back? Why do they walk in voluntarily, again and again? And why, when outsiders call the industry predatory, do so many of the trapped defend it? Those are not the reactions of people who were tricked once. They are the reactions of people held inside something more deliberate than a trick, something built. Because that receipt, the $1,200 paid, the $300 still owed, did not come from a mistake. It did not come from a borrower who did the math wrong, or a lender who got greedy in the moment. It came from a design, a specific one, engineered by specific decisions. And to see it, you rewind to the day it began. Rewind to the day it began. And the striking thing is how little drama there is in it. A woman, call her a composite of the roughly 12 million Americans who use these loans in a given year, is standing in her kitchen on a Tuesday looking at an estimate for a car repair. $340. The alternator. Without the car, she does not get to the job that pays for the car, and that math is not abstract to her. It is the difference between Thursday shift happening and Thursday shift being given to someone else. She runs the options, and she runs them the way a careful person runs them. The credit card is near its limit, the available room would not cover the repair, and the overlimit fee would eat what room there was. A bank overdraft would trigger a $35 charge per transaction, and there is more than one transaction between now and payday. Asking family is possible in theory, but the last ask is still quietly unrepaid, and pride is a real cost, even when it does not show up on a statement. A traditional installment loan from a credit union might carry a reasonable rate, but approval takes days she does not have, and her credit score sits in the range where the answer is often no anyway. So she does the arithmetic that the storefront is counting on her to do. $300, available in 20 minutes, against a fee of $45. Payday is in 14 days. The paycheck is real. It is scheduled. It will land. On day 14, she repays $345. The car is fixed, the shift is worked, and the whole episode closes as a footnote. $45 to keep her job. Framed that way, and it is a fair way to frame it, it is not a reckless decision. It is arguably the responsible one. She is not gambling. She is bridging a gap she can see the far side of. This is the part the outrage coverage tends to skip, and skipping it is a mistake, because it misreads who walks through the door. The caricature is a person who cannot count, seduced by neon. The reality is closer to the opposite. The people who use these products are frequently the ones doing the most counting, weighing 4 bad options and selecting the one that looks least bad on a 14-day horizon. They are employed. Federal data has consistently shown the typical borrower has a steady income and a checking account. You cannot get the loan without them. This is not a market of the reckless. It is a market of the constrained. And her calculation on its own terms is sound. If the world behaved the way her arithmetic assumed, the story would end at day 14 with a footnote and a fixed alternator. But look closely at the assumption doing all the work in her math. She assumed the loan was a bridge, a thing with 2 ends, borrowed here, repaid there. She assumed the transaction on day 14 would be the mirror image of the transaction on day 1. Money out, then money back, done. That single assumption is the whole game. It is the hinge the entire industry turns on, because the contract she signed was not written to be a bridge. It was written for what happens when the far end of the bridge does not quite reach, when the paycheck lands but rent lands the same day, when $345 leaving the account on Friday means something else cannot be paid on Saturday. Her decision was sound on day 1, everyone's is. The trap was never in day 1. It lived in day 14, in a clause she signed and almost certainly never read aloud, a clause that decides what the loan becomes the moment repayment gets hard. Day 14 arrives, and the paycheck arrives with it. That part of her arithmetic was correct. The money is real, it is in the account, and for a few hours the whole episode looks like it will close exactly as planned. Then the account resolves in order, and the order is not hers to choose. Rent had cleared that morning. Automatic, the way she set it up years ago so she would never forget it. The electric bill posted the same day. By early afternoon, the balance that was supposed to hand $345 back to the storefront is short by roughly $110. Not short because she was careless. Short because 2 obligations she also could not skip happened to land on the same Friday. The bridge reached the far bank. The far bank had already been claimed by someone else. So she drives back to the storefront to explain, braced for the confrontation, the demand, the collections tone, the pressure. And the confrontation never comes. This is the part worth slowing down for, because it is where the mechanism actually shows itself. The person behind the counter is not angry. The person behind the counter is helpful. There is, she is told, an easy option. She does not have to come up with the full $345 today. She can simply pay the fee, the $45, and the loan rolls forward another 14 days. Same terms, same storefront. Nothing on her record, no default, no collector. Pay the $45, keep the $300, come back next payday. The relief is immediate and physical. The crisis she walked in with dissolves into a small, manageable transaction. That relief is the product, not a side effect of it, the product itself. Watch what the renewal actually does, mechanically, stripped of the friendly framing. She hands over $45. In exchange, she receives nothing new. No additional money leaves the store with her. The $300 she still owes does not shrink by $1. What she has purchased, precisely, is 14 more days of owing the same amount. The fee did not buy down the debt. It bought time on the debt. And time on this debt is the single thing the lender is in business to sell. Here is the structural slight, and it is not hidden in fine print. It is hidden in relief. A normal loan payment does 2 jobs at once. It costs the borrower something, and it reduces the balance. Those 2 jobs are welded together, which is why paying feels like progress. The renewal surgically separates them. The cost stays. The reduction disappears. She pays, and the number she is paying against never moves, because the payment was never pointed at that number. The collision on day 14 was inevitable rather than unlucky. The loan was sized to a paycheck. Repaying it in full requires surrendering an entire paycheck's worth of room at once. The same paycheck already spoken for by rent, food, the electric bill, the ordinary weight of the 2 weeks that just passed. The full repayment and the cost of living were designed to compete for the same dollars on the same day. Only one can win. When living wins, the renewal is waiting, warm and reasonable to catch the fall. She leaves lighter than she came in. The problem is solved. The counter was kind. On the drive home, it genuinely feels like she handled it. Like a responsible person met an obstacle and cleared it for $45. She has no reason yet to see the $45 as anything but a one-time cost. Neither would most people. A single renewal, taken alone, is a nuisance and nothing more. A bad Friday, a small fee, a story she would forget by Monday. One renewal feels harmless. But the renewal was never meant to happen once. A single renewal is harmless. 14 renewals is a business. And the distance between those two facts is not an accident of human weakness. It is a decision made in a specific decade, in specific offices, by people who read the same arithmetic you have now seen and drew a conclusion from it. To understand what changed, start with what the product used to be. The small dollar loan is old, older than the storefront, older than the neon. For most of the 20th century, lending against a worker's next paycheck existed in a legal gray zone, run by operators the respectable financial world kept at arm's length. It was marginal, semi-legal, and, this is the part that matters, structurally shaped to be repaid. The salary lenders of the early 1900s, the ones reformers spent decades fighting, made their money on interest that accrued while the loan was outstanding. Their incentive, however predatory the rate, still bent toward the loan ending. A loan that never resolved was a collection problem, not a profit center. Then the model was rebuilt. In the early 1990s, a wave of state-level deregulation, check cashing laws rewritten, usury caps carved with exceptions, deferred deposit carved out as its own permitted category, legalized the storefront payday loan across a growing map of states. The industry went from a few hundred outlets to tens of thousands over roughly a decade. And in that expansion, the economics were quietly re-engineered around a single line item, the fee. Here is the turning point, and it is a shift in what the lender counts as a good outcome. The old salary lender profited when you paid. The new payday model profited when you paid to not pay. The flat fee, that $45, was decoupled from repayment entirely. It was charged for the 2 weeks of access, not the shrinking of the balance, because under the new structure the balance was not designed to shrink. Revenue stopped being a function of principal repaid over time, and became a function of renewals booked over time. The metric the industry began optimizing was not loans closed, it was loans kept open. And this is where the historical parallel earns its place, because the shape is not new, only the paperwork is. The sharecropping ledger of the post-Reconstruction South ran on the same logic. A worker borrowed against a future harvest for seed, tools, food, advanced at the plantation store. The debt was structured so that each year's earnings covered the interest and the store's inflated prices, but never quite cleared the principal. The books were kept by the same party the worker owed. Every settlement day, the number carried forward. The system did not want the debt repaid. A cleared debt was a worker who could leave. It wanted the debt renewed, season after season, because the renewal was the leash. Historians who studied those ledgers found accounts that ran for years, even decades, against harvests that objectively should have settled them. The mechanism is identical, and the identity is not rhetorical. In both cases, the lender controls the terms of settlement. In both cases, the fee or the markup is welded to time, not to principal. In both cases, a cleared debt ends a profitable relationship, so the structure is tuned to prevent clearing. The sharecropping store and the payday storefront are the same machine in different clothing. One enforced by law and geography, the other by arithmetic and a 14-day clock. What the 1990s redesign accomplished was to take a form of debt bondage that had always required coercion, the plantation, the company town, the threat behind the ledger, and replace the coercion with consent. No one is forced back to the storefront. The math does the forcing. The loan is simply sized so that full repayment competes with survival, and renewal is offered as mercy. The leash became voluntary. That was the innovation. So the ordinary $300 decision, The sound one, made by a careful person on a Tuesday, became a debt that outlived the alternator, outlived the reason for borrowing, because the product she signed was no longer built to end. It was built to renew. The reason her balance never moved is that a moving balance was never the plan. Once renewal became the point, the math stopped serving the borrower and started serving the calendar. Run two loans side by side, and the shape of the trap stops being a metaphor and becomes a line on a graph. Loan A is a conventional installment loan for $300 from a credit union. It carries a rate that looks high on paper, say 28% annual, the ceiling many credit unions use for small dollar credit. It is scheduled across 6 months. Each payment does two jobs welded together. It covers the interest for that period, and it carves off a piece of the principal. Month 1, the balance drops. Month 2, it drops again, and because the balance is smaller, the interest portion shrinks with it. The curve bends downward. By design, every payment makes the next one easier. The borrower pays roughly $45 in total interest across the life of the loan, and at the end the balance is zero. The line reaches the floor and stops. Loan B is the storefront payday loan for the same $300. Same borrower, same need, same starting point. The fee is $45 every 14 days. And here the curve does not bend. It does not bend because the payment is not pointed at the principal. It is pointed at the calendar. 14 days pass, $45 leave, and the balance stands exactly where it stood. 14 more days, another 45, and the balance has still not moved. The line does not descend. It runs flat and forever, and every point on it is a payment that bought nothing but the right to arrive at the next point. Now overlay them, because the overlay is the whole autopsy. At the 6-month mark, Loan A is finished. Total cost to the borrower, about $45, the debt discharged. At the 6-month mark, Loan B has consumed 13 fees, roughly $585, and the $300 is still owed in full. Same principal. Same person. The difference between $45 retired and $585 spent is not a difference in the borrower. It is a difference in which direction the math was built to run. That is the central truth this block exists to state plainly. The trap is not the interest rate. A high rate on a repaying loan still ends. The trap is the amortization, or rather, the deliberate removal of it. Strip the principal reduction out of a payment, and you have not made a more expensive loan. You have made a loan that cannot be finished by paying it. The borrower can be perfectly disciplined, hand over the fee on time every single time, never miss, never default, and move not 1 inch closer to freedom. Discipline does not help, discipline is monetized. Watch how that unfolds on the lender's side, because it inverts everything a person expects about risk. In Loan A, the borrower who pays on schedule is the healthy account, and the borrower who cannot pay is the loss. In Loan B, it flips. The borrower who produces the full $345 on day 14 closes the account and closes the revenue with it. The most profitable borrower is not the one who repays. It is the one who renews on time, indefinitely, forever short of the full amount but never quite in default. The industry's ideal customer is a specific and precise creature, not the one who pays it off. She leaves, not the one who defaults entirely. He stops paying. The ideal customer is the one suspended exactly between, reliably able to produce the fee, reliably unable to produce the principal. Perpetually behind, perpetually current. On a conventional ledger, a borrower who has paid $585 and still owes $300 is a person in deep distress. On this ledger, that same borrower is the single most valuable line in the book, which raises the question the numbers now force. If the best outcome for the business is a borrower who never finishes, then the borrower's failure to repay on schedule is not a risk the lender tolerates. It is a state the lender needs. So why is that the healthiest thing that can happen to the lender's books? On paper, the customer is failing. On the ledger, that failure is the asset. Roughly 3 out of every $4 this industry collects come from borrowers who were already trapped when they paid it. That is not an interpretation. It is the finding of the federal regulator that spent a year reading the loan level data. In 2013, the Consumer Financial Protection Bureau examined a full portfolio of storefront payday loans and traced what happened after the first 14 days. The picture it assembled did not describe a lending market. It described a retention machine. 4 out of 5 loans were rolled over or followed by another loan within 2 weeks. And the revenue clustered exactly where the churn was densest. Borrowers caught in 7 or more loans in a year. The deeply stuck, not the occasional user, generated the overwhelming majority of the fees the industry booked. Set that beside the story the industry tells about itself, because the contrast is the whole point. In its own marketing, the payday loan is a bridge, a one-time tool for a one-time gap, used by a sensible person on a bad Tuesday and left behind by the next payday. That customer exists. The woman with the alternator was, on day 1, exactly that customer. The problem is that if she behaved the way the marketing describes, borrowed once, repaid once, walked away, the industry as it is currently sized could not exist. A market of one-time users does not support tens of thousands of storefronts. The one-time borrower is a rounding error on the revenue statement. Now deepen it, because the number underneath the number is where the design becomes undeniable. The CFPB found that a large share of all fee revenue came from borrowers who spent the majority of the year in debt. People who took out 10, 12, sometimes more than a dozen loans across 12 months, each one renewing the last. These were not the reckless and not the defaulted. They were the reliable. They paid, on time, over and over, and in paying, they never left. The account that produces the most money is the account that never closes. Follow that to its conclusion, and something inverts that most people never fully absorb. On a conventional lender's books, a borrower who repays on schedule is the healthy account, and a borrower who cannot is the problem to be managed. Here, the polarity reverses. The borrower who produces the full principal and walks out is the lost account, the revenue that just ended. The borrower who can only ever produce the fee 14 days at a time, forever short of the balance, is the account that performs. Her inability to repay on schedule is not friction in the model, it is the model's optimal operating state. That is why the trapped borrower is not a failure the industry regrets and quietly tolerates. She is the outcome the revenue depends on. When the majority of the money arrives from the minority of customers who cannot get out, the business has been sized, staffed, and located around them. The storefront count, the marketing budget, the 2-week clock, all of it is calibrated to the customer who returns, not the customer who leaves. The answer to the question left open is almost clinically simple, and it is the coldest fact in this entire investigation. A borrower who repays on schedule is, to this ledger, a small and finished transaction. A borrower who cannot is a recurring one. The healthiest state for the lender's books is a customer permanently a little behind, because behind is where the fees renew. The distress that would appear on any normal balance sheet as risk appears on this one as revenue quality, which is why the language matters so much to the people selling it. A business that earns most of its money from its worst outcomes cannot describe those outcomes as harm. It has to describe them as service, and the customers producing that revenue have to be told, and often come to believe, that what is happening to them is help. Ask a trapped borrower to describe the storefront, and the word that comes back most often is not predator, it is friend. She will defend the place that took $1,200 from her over $300, and she will mean it. That is not delusion. And treating it as delusion is the mistake that keeps outsiders from understanding the machine at all. Start with the strongest version of her position, stated honestly, because it deserves to be. When she stood in her kitchen on that Tuesday, the storefront was the only door that opened. The bank said no. The card was full. The credit union needed days she did not have. The payday lender said yes in 20 minutes, without a lecture. And on day 14, when the money was short, the counter did not shame her, it offered relief. Every interaction she has had with this business has, in the moment, made her problem smaller. Judged interaction by interaction, the product has never once failed her. It has helped, visibly, every time she walked in. On what grounds is she supposed to call that a trap? That is the steelman, and it is not weak. It is the reason the model is durable. Now watch it fall. The word help describes a comparison, always. Something helps relative to what would have happened without it. And here is what marketing research on the sector keeps surfacing. The borrower is systematically prevented from ever seeing the comparison that would expose the product. A study published in the Journal of Marketing Research examined how payday advertising and disclosure framing shape borrower perception, and found that when the cost was expressed as a flat fee, $45, rather than as an annual rate or as a running total across renewals, borrowers rated the loan as dramatically more reasonable and were markedly more likely to take it. The framing did not describe the product accurately, it described the product in the one light under which it looks like a favor. Consider what that framing systematically omits. It never sets the $45 fee beside the $45 total cost of the credit union loan that would have retired the same debt. It never renders the flat line of the renewal against the descending curve of an amortizing one. It never shows the borrower the version of a $300 loan that ends. The relief at the counter is real precisely because the alternative that would make it look like harm is never in the room. This is the quiet architecture of the whole belief. She is comparing the storefront to the bank that rejected her, and against that, the storefront is genuinely kinder. What she is never invited to compare it against is a loan built to be repaid, because that loan is not offered to her, not marketed to her, and not present in any disclosure she signs. The comparison that would reveal the fee as a leash rather than a lifeline has been engineered out of her field of view. She is not choosing the trap over freedom. She is choosing the trap over a worse trap, which is the only choice she was ever shown. So the friend she defends is not a friend she imagined. It is a friend she was carefully positioned to perceive. The gratitude is manufactured the same way the debt is, by controlling what the borrower is allowed to see at the moment of decision. Call the product help enough times, in the one frame where it looks like help, and eventually the person paying $500 against a $300 balance will say the word back to you, unprompted, and defend it to a stranger. Because to believe the product is help, you have to never meet a version of it that isn't. A person who earns too little cannot be trapped by this product. Neither can a person who earns enough. The trap has a target, and the target is narrower than either edge of the income scale. A fact that becomes obvious the moment you ask who the model is actually built to keep. Start from the machine's own requirements. A borrower who defaults on day 14 and never returns is worthless to the ledger. There is no fee stream, only a write-off. A borrower with real financial slack is worse than worthless. She repays the $345, closes the account, and the revenue ends the same afternoon it started. Neither extreme produces the thing the business runs on. What the business runs on is the fee, repeated. And the fee can only repeat if the borrower can reliably produce $45 and reliably cannot produce $345. That is not a wide band. It is a sliver. The industry does not need the poor in general. It needs a very specific creature, solvent enough to keep paying, constrained enough to never finish. Employed, banked, income steady. Every underwriting requirement filters for exactly that. You cannot get the loan without a paycheck, because the paycheck is what the fee is drawn from. But the loan is sized so the paycheck can service the fee and never the principal. The dial is set to the exact point where a person can bleed indefinitely without ever bleeding out. Consider two composite borrowers who walk into the same storefront on the same afternoon. The first earns enough that the $345, while inconvenient, fits inside a single pay period without cascading into missed rent. On day 14, she produces the full amount, closes the loan, and leaves. To the marketing, she is the success story, the one-time user, the bridge crossed. To the revenue statement, she is a rounding error the model would prefer never to have booked, because she paid one fee and vanished. The second earns just under that threshold. Her paycheck covers the fee with room to spare, but surrendering the full principal on day 14 would mean rent, or the electric bill goes unpaid on Saturday. So she pays the $45 and rolls. Her income is high enough to service the loan forever, and low enough that the loan can never be retired in a single stroke. She is not the failure of the model. She is its center of mass, the account it was designed around, staffed for, and located near. The distance between those two women is not character. It is perhaps a few $100s of monthly slack. One has enough room to escape. The other has exactly enough room to keep paying and not enough to leave. The entire profit engine lives in that gap, and the underwriting is a filter for finding people who sit inside it. Now apply this outward, because the pattern is portable. Any product whose revenue depends on renewal rather than completion will calibrate the same way toward the customer who can sustain the recurring cost but cannot afford the exit. The overdraft program that earns most from the account holder who is chronically $50 short, never overdrawn enough to close the account, never flush enough to stop. The subscription structured so cancellation is friction and continuation is default. The rent-to-own contract priced so the weekly payment is survivable and the buyout never is. In each case, the business is not hunting the destitute or the comfortable. It is hunting the person suspended precisely between solvent enough to feed it, stuck enough to stay. That is the generalizable tell. When a product's ideal customer is neither its most capable nor its most desperate, but the one calibrated exactly to keep paying without finishing, the product is not serving a need. It is farming a margin. And a margin that precise is not a law of nature, it is a setting. A dial turned to one position, which means somewhere, in some market or some era, the same product had its dial turned to another and did not trap anyone at all. Walk into a credit union in Bakersfield or Amarillo, or any of several hundred small institutions running a program most Americans have never heard of, and ask for $300 against your next paycheck. You will get it. Same day, sometimes same hour. The clerk will not shame you, and the money will land in your account before you leave the parking lot. On the surface, nothing distinguishes this transaction from the one at the storefront across the street. Everything distinguishes what happens next. The product is called a payday alternative loan. A small dollar loan federal credit unions have been permitted to offer since 2010, capped by regulation at an interest rate a fraction of the storefronts, and required by the terms of the program to be structured as an installment loan. Not a 14-day fee that renews, an amortizing balance that descends. The National Credit Union Administration, which authorizes these loans, sets the ceiling and mandates the shape. The borrower repays principal on a schedule, and when the schedule ends, the loan is gone. Here is the observation worth pausing on. This is the identical customer. Same income band, same thin savings, same bad Tuesday with the alternator. The person who takes the payday alternative loan is not more disciplined, not better educated, not blessed with a cushion the storefront borrower lacks. Federal data on who uses these products shows the same demographic profile walking through both doors: employed, banked, constrained. If the trap were a function of the borrower, both borrowers would fall into it, only one does. Which forces a conclusion the entire industry depends on you never reaching. The variable that decides whether a $300 loan ends or runs forever is not the person holding it. It is the structure printed on the contract. Change nothing about the borrower, same paycheck, same discipline, same margin of slack, and change only whether the payment reduces principal, and you change the outcome completely. One loan is a footnote by summer. The other is still open, still charging, still owed in full. Expand that, because the counterexample is not confined to one program in one decade. For most of the 20th century, the credit union movement and the industrial loan companies that preceded it made small loans to working people at rates that would horrify a modern regulator, and those loans ended. They ended because interest accrued against a shrinking balance, so every payment moved the borrower towards zero. The rate was high, the direction was still down. A worker in 1955, borrowing against wages from a company credit union, paid dearly and paid off. The product that trapped no one, and the product that traps almost everyone are, functionally, the same act of lending $300 to a person who is short. The only difference is which direction the arithmetic was pointed. The modern comparison makes it unarguable. The payday alternative loan and the storefront payday loan compete for the same customer, in the same neighborhoods, in the same year, under the same economy. One is engineered to amortize. One is engineered to renew. The borrowers are interchangeable. The outcomes are not, and the outcomes diverge entirely along the single line where the payment either touches principal or does not. So the story the industry tells about its trapped customers, that they lacked discipline, that they should have known better, that the free market simply revealed who could handle credit and who could not, collapses against its own counterexample. Put the undisciplined borrower into an amortizing loan and she pays it off. Put the disciplined borrower into a renewing one and she pays forever. Discipline was never the variable. It could not have been, because the same people, sorted only by contract structure, land in opposite places. The difference was never the borrower's discipline, it was a single structural choice made by someone else before she ever signed. Which line in a loan contract decides before the borrower ever signs whether she walks out in 6 months or stays for 6 years? It is not the rate, it is not the fee, it is not her income, her discipline, or the size of the emergency that sent her through the door. All of those change the price of the loan. Only one thing changes whether the loan can be finished by paying it. And that one thing is whether each payment is allowed to touch the principal. Set 2 clauses side by side, stripped of everything else. Clause 1 reads, in effect, each scheduled payment shall be applied first to accrued interest and the remainder to principal. That sentence is the whole difference. It welds cost and reduction together. Every dollar the borrower hands over does 2 jobs at once. It pays for the time she has borrowed, and it shrinks the thing she is borrowing against. Because the balance falls, the next interest charge is smaller, which means more of the next payment reaches principal, which means the balance falls faster. The clause builds a curve that bends towards zero and cannot help but arrive there. A borrower could pay this loan on autopilot, understanding none of it, and still be free by summer. The structure does the escaping for her. Clause 2 reads, in effect, at maturity the borrower shall repay the principal in full, or pay a renewal fee to defer the principal for an additional term. Read it slowly because the trap is entirely inside that word defer. This clause surgically severs the 2 jobs the first clause welded together. The fee covers the time. Nothing covers the principal. The payment is pointed at the calendar, not the balance, so the balance never moves, so the fee never shrinks, so the next payment is exactly as large as the last one, forever. The curve does not bend. It runs flat off the edge of the page. And a borrower could pay this loan flawlessly, on time, every 14 days, with perfect discipline, and die owing the original $300. Here is the lesson, and it is smaller and colder than the outrage around it suggests. The trap is not high cost. High cost on an amortizing loan is expensive and survivable because it ends. The trap is the deliberate removal of amortization. The specific engineering choice to charge for time while forbidding the payment from reducing what is owed. Strip principal reduction out of a payment, and you have not built a pricier loan. You have built a loan that repayment cannot close. The distinction between $45 retired and $585 spent is not a distinction between 2 borrowers or 2 rates. It is the distinction between a payment that descends and a payment that treads water. Same person, same $300, same discipline. One clause, inverted. That is why the counterexample held. The credit union borrower and the storefront borrower were interchangeable, and their outcomes were not, because the variable was never in the borrower. It was in whether the contract permitted the payment to arrive at the principal. Name that variable precisely. Payment reduces balance or payment rents time, and you can hold any small dollar contract up to the light and know, before a single dollar changes hands, which direction its arithmetic will run. And once you can name it, you stop looking only at loans. Because the same fork appears anywhere a payment is collected on a schedule. Does the monthly charge move you toward owning the thing? Or only toward keeping access to it another month? Does the fee retire an obligation, or merely defer it? Does the structure bend toward completion, or run flat toward renewal? The question that decides a payday loan is the same question that decides a lease, a subscription, a rent-to-own contract, a financing plan dressed as convenience. The variable does not care what the product is called. Which means the tell you have been handed is not about cash loans at all. It is a single question you can now ask of almost anything you pay for on a recurring basis. A leash and a ladder can be built from the same rope. What separates them is not the material. It is the direction the rungs face, whether each step carries you upward and out, or simply resets you to the same height, holding you in place while you exhaust yourself climbing. The payday storefront is a leash dressed as a ladder. And once you have seen the knot, you start seeing it everywhere tied into products that have nothing to do with a paycheck loan. Look at the overdraft program running quietly on tens of millions of checking accounts. The bank does not earn most of its overdraft revenue from the person who slips underwater once and never again. It earns it from the account holder who is chronically a few dollars short, the one who overdrafts, pays the $35 fee, gets pulled current by the next deposit, and slips under again a week later. Federal regulators found that a small fraction of account holders generate the large majority of overdraft fees. Same structure. The fee is charged for the shortfall, not for closing it, and the account is never fixed, only rented current until the next time. Look at rent to own. A weekly payment sized to feel survivable, on a sofa or a laptop priced, by the time the contract completes, at 2 or 3 times its retail value. The weekly number is the fee. Ownership is the principal. And the contract is built so that missing a payment near the end can void the accumulated equity entirely, resetting the borrower to zero on a thing she has already paid for many times over. The payment rents access. It does not, until the very last moment, purchase the object. Look at subprime auto lending, where the loan is stretched across 7 years on a car that will not last 5, so the borrower spends the back half of the term owing more than the vehicle is worth, underwater, unable to sell, unable to trade out, financially welded to a depreciating asset. Look at buy now pay later, where the frictionless 4-payment split trains a purchasing reflex, and the revenue concentrates in the late fees and the repeat users who stack plan on plan, until the running total is a debt they never decided to take on. Now hold all 4 beside the payday loan and ask what they share. It is not the interest rate. The rates vary wildly. It is not the customer. The demographics scatter. It is the single structural fact that decides everything. The payment is pointed at time, not at completion. The fee retires nothing. The obligation defers rather than ends. The curve runs flat instead of bending toward zero. In every one of these products, the ideal customer is the same creature the storefront was calibrated to keep, solvent enough to sustain the recurring charge, constrained enough to never reach the exit. This is the shape the entire investigation has been circling. Not a villain, not a single storefront, not a rate high enough to gasp at, a structure. A design choice that severs cost from reduction and charges you, indefinitely, for the privilege of not finishing. Once you can name that choice, does this payment move me toward owning it and out, or only toward keeping access another cycle? You are no longer at the mercy of the framing. The flat fee stops looking like a favor. The low monthly payment stops looking like relief. The frictionless split stops looking like convenience. You can hold any recurring obligation up to the light and see which direction its arithmetic runs before you sign. And that is the quiet power of the tell. It travels. It does not care whether the product wears neon or an app icon, whether it is sold as a lifeline or a lifestyle. Wherever a payment is collected on a schedule, the same fork waits, descend toward completion or tread water toward renewal. But naming the structure explains the machine. It does not explain the strangest part, the part that has stayed open since the first receipt. Because the people held inside these designs, the ones paying most and escaping least, do not, by and large, want them abolished. They come back. They recommend them. They call them fair. So the real question was never about one storefront. It was about why the trapped keep defending the trap. The trapped defend the trap because, from the inside, it never once looked like a trap. It looked like the only door that opened, and then like the hand that caught them when they fell. Ask yourself the question they are answering, and their loyalty stops being a mystery and becomes almost inevitable. Here is the question you have been circling for the length of this investigation, and it is worth putting to you directly because it is the same question the borrower answers every time she walks back in. When something helps you at the exact moment you are drowning, and asks for nothing but a small fee to do it, how do you learn to call it the thing that is drowning you? You cannot, not from where she stands, because to see the storefront as the trap, she would need to see, side by side, the version of the loan that ends, the amortizing curve bending towards zero, the $45 retired instead of $585 spent. That comparison is the one thing the entire structure is built to keep out of the room. She is comparing the storefront to the bank that rejected her, and against that the storefront is genuinely kinder. She is not defending a trap over freedom. She is defending the only mercy she was ever shown over the refusal that came before it. So consider what that means for you, watching from outside, holding the tell you now have. The gratitude is not evidence the product is fair. It is evidence the framing worked. A business that earns most of its money from its worst outcomes cannot afford to let its customers name those outcomes as harm. So it teaches them to name it help, in the one light where help is the only word that fits. The defense you hear is the design, spoken back to you in the borrower's own voice. And this is where the whole machine finally resolves, quietly, without a villain and without a single dramatic act of cruelty. No one forced her back. The math did the forcing. No one lied outright. The framing simply removed the comparison that would have exposed the truth. No one made her grateful. The structure made gratitude the only reasonable response to the one door that opened. Every step was legal, respectable, and calibrated. And the sum of those calibrated steps is a person who has paid 4 times what she borrowed, still owes the original, and will tell a stranger the place that did it to her is fair. That is why the customers keep coming back, not because they are foolish and not because they cannot count. They come back because the product is genuinely the best of the bad options they were shown, and because the option that would reveal it as a trap was carefully kept off the shelf. They defend it because, interaction by interaction, it has never failed them, and no one ever let them see the version of it that would. You are in a different position now. You have seen the comparison. You have the fork. Does this payment move you toward owning it and out, or only toward keeping access another cycle? That single question travels across loans, leases, overdrafts, subscriptions, any obligation collected on a schedule. It is the one tool the framing cannot take back, because it works before you sign. In the moment, the neon and the app icon and the low monthly number are all trying to be the only thing you see. So return, one last time, to the receipt from the very beginning. $300 borrowed, $1,200 paid in fees, the $300 still owed. It looked, at the start, like a tragedy, a person overwhelmed by bad luck. You know now, it was never the exception, never the borrower failing, never the system breaking down. It was the system working exactly as it was rebuilt to work in the 1990s, keeping a solvent, disciplined, ordinary person suspended precisely between paying and finishing, forever. Wealth is built to last, so deliberately was this. The receipt was never the accident, it was the product, performing. This is education, not personalized advice.